Welcome back to another episode of The Funding Blueprint, the podcast that delves into the dynamic world of startups, entrepreneurship, and innovation. I'm your host, Abraham, and I'm thrilled to introduce today's guest, Rafael Valdivia, a seasoned entrepreneur and investor with an impressive track record in the world of finance and venture capital. Originally from Sao Paulo, Brazil, Rafael's journey into entrepreneurship began after several years in investment banking. In 1998, he co-founded one of Brazil's first online stock trading platforms, propelling him into the world of entrepreneurship. This venture eventually led him to joining Hedging Griffo, where he oversaw a diverse portfolio that reached $3 billion in assets under management at its peak. Following the acquisition of Hedging Griffo by Credit Suisse, Rafael continued to make waves in the entrepreneurial landscape, launching a series of successful ventures across various industries from restaurants to clean energy. Recognized for his entrepreneurial prowess, Rafael was named Emerging Entrepreneur of the Year in 2014 by EY Brazil, and was selected as an Endeavor Entrepreneur by Endeavor Global. Since 2014, Rafael has been based in the US, where he has made significant investments in early-stage companies, achieving impressive returns. In 2019, Rafael joined Lab Ventures as a managing partner, where he has been instrumental in institutionalizing processes and procedures while supporting the growth of the venture capital investment platform. With a keen eye for emerging trends and a passion for driving innovation, Rafael continues to make an indelible mark on the startup ecosystem. Today we'll delve deep into Rafael's journey, his insights into venture capital, and the exciting developments happening at Lab Ventures. So without further ado, let's welcome Rafael to the show.
Oh, thank you. I'm glad to be here. Happy to be part of the podcast. I mean, I'm super happy with it.
Of course, and the pleasure is all ours. So I want to kind of hop right in here. The startup world thrives on innovation and ambition, but these ventures often require significant amounts of capital in order for them to reach their full potential. That's where venture capital kind of comes into play. They act like fuel injectors for promising startups, providing the financial resources that are needed to propel them towards growth. But how exactly do these firms operate? What motivates to invest into these risky ventures, and how do they ultimately generate returns for the institutions and individuals who entrust them with their capital? So Rafael, can you walk us through the inner workings of a VC fund? How do they operate, and how do they generate returns on their investors?
Oh no, awesome! It's an important question. We all the time feel that some entrepreneurs, they are not aware of how the financial services industry work, and venture capital is part of the financial industry work. I mean, it's basically what venture capital firms they do is they raise money from LPs, limited partners that are investors. That can be institutional investors, that can be corporates, that can be individuals looking for interesting returns. They're looking for some nexus to their investments, and the venture capital firms are the mean to that investment. Most people believe that we have that money sitting in the bank, just ready to be deployed, etc. And that's not how that works. So usually when we mention that we raised a new fund, that means that we have commitments from those LPs, those investors. And once we find the deals that we are looking for that have nexus for those LPs, that's when we write checks. That's when we invest the money into those companies. But before that, we need to make some capital calls from those investors to the fund, and then the fund wires the money to the company. So it's a little bit of a clunky process. It's not like fully streamlined. Some companies they can find some financing for that period between investing and have the capital calls. So that's also usual, but it's not that we have the capital there available, like at all the times for those companies. And there is another point which is important, which is when we invest, we are willing to, of course, make that company successful. So usually most venture capital funds will give these companies a push, introducing them new customers, helping them with strategy, maybe with finding some human resources, introducing potential executives or team members. And of course, it's something that needs to be agreed before the investment. What are the roles of the investor and the company in that relationship? And of course, we make money when we exit the company. So when the company is sold or the company IPOs, that's where investors make their money, and when venture capital firms make their money. Because typically, an investment venture capital fund will charge some points on that capital, but that's for expenses. Venture capital firms are not making money out of that. They are, of course, paying their analysts, paying their systems, paying their operational costs to run the business, but they are not making money out of it. They make money when the investment is successful, and after returning all the money back to their investors, that's when they make their cut. So typically 20% of the excess capital. So, and another thing which is important is that the funds, they have a cycle. So it's not that the funds are there forever. Typically, we have a 10-year term to return the capital to investors, and typically we have like 4 to 5 years of investment period, because those investments, they need to mature, they need the companies need to be successful, and that takes time. So it's not something that will happen in just a few years. It's gonna be like, I don't know, close to 10 years for those investments to be successful and the capital going back to the investors. Another point which I think is super important is that some entrepreneurs think that venture capital work as a revolving line of credit, right? So you can draw the money anytime you want, and that's not how that works. Venture capital firms, they have a strategy to deploy that capital. They have a certain number of investments they want to do, something between 10 and, in some cases up to 50 investments with that money. And then, so you cannot like keep investing in the same companies all the time. You need to diversify your portfolio. And the fund has policies, and there's a criteria to do that. So it's not something that we are, out of our minds of deciding, oh, we can do this, we can do that. That there is a mandate, there is a policy in place, etc., that needs to be respected. That's what we agree on with our LPs, and we need to respect that. So that's another point which, sometimes we see some confusion between like, oh, but you have all this money, why cannot you write me another check? So no, that's not what we agree on with our investors. So I cannot do that. So unfortunately, but but again, there is policies for follow-ons that said also policies for follow-ons. So it's important for founders and entrepreneurs understand how a venture capital firm works, and if there is a correct fit between the company and the fund. In terms of this fund cycle, in terms of the check sizes, in terms of the strategy, in terms of how the procedures work. If the company is looking for more than capital, and if the venture capital firm is able to provide more than capital to the company, that needs to be agreed on before the investment.
100%. What's actually interesting is to your point. I mean, VC firms just in general. Obviously, correct me if I'm wrong, but they kind of take on a very similar role as founders because they themselves also have to fundraise for their own fund. So VC firms and founders they share a commonality in that respect. Is that in a very similar fashion they do fundraise as well, and their check sizes aren't really unlimited because it dictates on the funds. Not every fund is a large fund. So not every fund is capable of investing into 50 startups per fund. So it just really depends and varies. And what's interesting also to your point, another point is a lot of founders that I speak with don't really understand VC firms in general. I mean, you spoke about this earlier, but we kind of talked about how VC firms aren't just the investors that invest into your company and then they say, we gave you the money, you figure out what to do with it, right? Many VC firms, if they are a lead investor, they have a seat on your board, right? And they try to really assist you and provide as much resources and tools at your disposal, kind of benefit you. So it's not really a structure of where, we give you capital and we call it a day. They really want to have that support system to make sure that not just from an investment standpoint, but also from a resource standpoint as well.
Sometimes we read and, so there are some media pieces, articles stating that VCs are not good investors for the founders, etc. And that can be that can be reality in some cases, but most of the cases that we know, and the professional investors, the more sophisticated investors, they want that company to be successful. So they'll give a big push in, helping the supporting the company, not just with money, but with, as I mentioned, customer introductions, other investors introductions, discussing strategy, helping with human resources, all of that. So that's part of our commitment to the companies, in our case, to help them in those cases. And in some cases, even with tech development, not just your strategy or like meetings with the top management, but figuring out some code. So we do that as well. But so that's the point of venture capital firms specializing in doing what we're doing.
Right. No, 100%. And you're right. And I mean, venture capital firms, they're the ultimate hunters in a way, like when it comes to the startup world. So you know this better than anybody, working at a VC firm. Venture VC firms, they spend their days sifting through mountains of ideas, searching for those rare gems with the potential to explode into billion-dollar companies. But unlike prospectors with picks and shovels, VCs rely on a keen eye and a well-defined strategy to identify these hidden diamonds, these hidden gems. So with your experience in the VC world, what sets apart, a promising startup from the countless hopefuls vying for VC attention? And can you walk us through some of the key factors that you consider at Lab Ventures when it comes to evaluating potential investment opportunities?
Yeah, we are early stage investors, right? So we are typically investing in companies that they have like a handful of employees. They are starting with their product. They are just launching their product in the market. So we are talking about companies that are the very early innings. Um, so what we look at the most is the team. So first of all, the team is the most important part. We know that maybe the strategy will change, maybe the product will change, maybe how they are tackling the problem will change, but the team is the most important component. So we're going to check their backgrounds, their execution abilities, what they did in the past, what are their experiences, how much resilience they have, because building companies, the most important aspect is, some people think, oh, we have an edge here because the technology is super cool, etc. And that's not what makes companies successful. It's resilience. So if you think about I think the most successful entrepreneur that we all know, Elon Musk, right? This guy, he is the example of resilience. Everybody is punching him in the face like every day, and he's still there, like grinding and working long hours, 24/7, etc. And that's what we are looking for. We're looking for people that are buying in that kind of lifestyle. It's not a job; it is a lifestyle. You need to be resilient, and so we want that kind of commitment. That's the founders we are backing. On top of that, of course, the problem they are solving needs to be an interesting one, like a real problem, a real pain, something that is not helping, not available in the market, something that is the market needs a solution, and not just a cool piece of technology. Sometimes we see like a really cool tech looking for a problem, and that's not what we are looking for. We are looking for like teams that are 100% focusing on solving like a problem, a real problem, a big problem. And that leads us to the third component, which is the opportunity size. So can this company be large enough to return the fund, the results that the fund needs? Because there is fund economics that, like we are investing in 25-ish companies per fund. And we know that some of them will fail. So the companies that are successful, they need to be really successful. So the fund economics works. We, like investors, when they invest, they're expecting 30% return, annual returns, like more than that. So to cover those losses, the winners need to be like big winners. So we cannot invest in companies that are, like a great team and with great abilities and super resilient, solving a real problem where the company cannot be big enough for that exit to us. So that's one important aspect. I mean, maybe if you are a passionate entrepreneur working on that really important problem, but the problem is not big enough, maybe you should not be raising money with venture capital. You should be looking into different funding sources because that's not going to work for venture capital. So that's the main point in that case. So the three aspects we are looking for is team, and team is, I'd say, like we used to say, like we are early stage focused on prop tech, right? So real estate technology, construction technology. In real estate, we always say like the three most important parts are location, location, and location. So in the early stage investment, the team and the team and the team are the three most important part. And then we go with the problem and the opportunity size on a very secondary position. I mean, the team is the most important part.
I love that. The team, the team, the team. I love that. That's great. Um, the world of VC funding can feel like a complex dance. I'm kind of going through that right now. So, with different players taking on distinct roles. But one key dynamic is really the difference between a lead investor and a follow-on investor. Now, for our listeners that don't know, the lead investor often takes center stage. That person conducts the due diligence, sets the terms for the investment round. But on the other hand, the follow-on investor also plays a vital role. What they do is they provide additional fuel for the startup's growth journey. So, Rafael, with your experience navigating these funding rounds, can you break down the difference between a lead investor and a follow-on investor? And what are some of the key considerations for each type of investment decision, and how do these worlds really work together to support a growing startup?
Yeah, typically the lead investor is a venture capital firm or like the general partner that is leading that deal understands that space. So it's someone with experience in that space, in the area that the company is working on, understands how it works, understands the problems, the customers, etc. So they may have like a strong conviction in that deal. So they believe in the company, they think that's a good investment, and they will kind of invest all the time and money associated with leading around, which is not like small. So it's a lot of time, some real money with lawyers and preparing documents and checking all the company documents and talking to their clients, their customers, potential customers, and negotiating all the deal terms. So that's the role of the lead investor. And typically they will take like a large chunk of the round, more than half. If a lead investor is not taking like a large chunk of the round, we always like a little bit skeptical, like why this guy is leading this. So, like founders looking for a lead, they should be looking for someone that is able to take the whole round or a large chunk of the round. And because there is a large commitment to the deal to make it happen, it's a lot of drags a lot of resources. So it's important that the company, and the founder, to be honest, with the fund, and the fund being honest with the founder, like can they lead the round or not? Because that's something important to them, in both sides. So they have like a good fit, and that's important. You need to have someone that is going to probably have a board seat at your company. It needs to be someone that you can hang on with like pretty well. And it cannot be someone that it has a different personality, that you guys don't fit that well. So it needs to be someone that is the right person in the right company to invest. And then the follow investors are like typically strategic investors. It is someone that is not just filling the round because you may need more money, but someone that has some skill set or capability that's going to push your company as well, right? So it's not someone that is taking a ride on the deal. I mean, sometimes you need to get to give some rights like for free for these guys, right? Just to filter on because you need the money. I get that. But someone raising money that needs to filter on should be looking for a more strategic investors that understand the space and can be helpful with more than money. That's what we look at. And then these guys are looking into the terms. They typically will not have a board seat, will not have the like a larger commitment to the company, but they may be interesting investors. We from the 30 different we invested 38 rounds. We led a handful. So like it's and of course we are 100% focused in one industry specific prop tech, and we are always pushing our companies, etc. But I think we are good following investors as well. So that's at least that's what we are trying to do.
Right. Now, does Lab Ventures typically lead investments, or are they really more of a follow-on VC?
No, our previous fund was not set up to lead rounds. We led a few rounds with sidecar SPVs, and we are in the process of raising a new fund just to change that, so we can have the ability to lead the rounds on our own. Because sometimes we syndicated that lead with other investors, and that means that we need more time, we need to find the right partner, and that's why we are raising a new fund, so we don't need to go over that all the deals. So that's the idea there. So typically we in the past we were not leading that many rounds. In the future we expect to lead much more.
That's great. So for our listeners that are in the prop tech market and sector, definitely check out Lab Ventures because they are transitioning hopefully soon to a lead, more of a lead perspective, more of a lead take from an investment firm. So definitely keep a lookout for that, which is great. You know this better than anybody. The lifeblood of any startup is capital, right? And the size of a VC's check can really be a game changer. It can really make a world of a difference. Now, a hefty injection of funds can fuel rapid expansion, can assist with product development, with building out the team, but these VCs aren't really handing out blank checks. They strategically tailor these investment amounts based on the specific stage of a startup's growth. So, Rafael, your firm understands the importance of calibrated investments. Can you elaborate more on your firm's typical check sizes, for the different stages, such as, seed funding versus Series A rounds? And what are some factors that would influence your decision to participate in follow-on funding rounds for companies that already are within your portfolio?
Yeah, typically we invest very early, right? So from pre-seed up to a smaller Series A, because Series A's can be like, I don't know, a few $1 million up to $20 million in some instances. So we are more focused in the smaller companies at earlier stages. So we write checks that range from $100,000 to $1 million. We want to expand that a little bit up to 2.5 million. So typically depends on the company stage. If they're pre-product, product market fit, like they didn't launch yet, or if they already have revenues, they are just in the growth phase and they need some just fuel because the rocket is ready to be launched, etc. Then we can write like a bigger check. So typically what we are looking at is how much capital that company really needs, because we don't want that company to raise a lot of money and be diluted, because we know that will impact the future rounds and the company performance in the future. So we want the company to raise the right amount, and that needs to be like it's a case by case situation, where the money is going to be deployed, and how much of it the company really needs at this moment. We would like to make it more enough phased way. So it's a pre-seed, then a seed, then a Series A, then a Series B, a C, and so on. Because then you have the right risk mitigation at each round, and the less dilution for the founders. So that's how we see it. And to invest in follow-ons, what we are most looking at is the performance executed versus the forecasted. So if the company had a plan, and if they are on top of it, they are delivering it, they are over delivering it. That's what excites investors. So we wanna invest in those companies that are winning their spaces. So it's an expectations game. So what are the expectations? And if they're much better than the expectation, and it's not that the because like we know some companies that they're always trying to under promise to over deliver. But what we want to do is like, what's the plan? What can be done here? What's the goal? How big this can be? And if the company is doing that, that's the companies we want to continue to fund.
Pretty solid points in that respect. Because obviously, there's tons of startups out there that just they talk a big game, but when it comes to executing and implementing, they're not able to do it. People see the VC and startup founder relationship. It's often portrayed as a one-sided transaction. Like we talked about this earlier, the VC hands over the cash, the founder takes off running with it. But the reality is that it's far more nuanced. The best VC founder partnerships are built on trust, as you've seen, communication and a shared vision for the future. So beyond the initial investment, a strong VC firm actively supports these startups. So in their portfolio, they provide guidance and resources to navigate the challenges of growth. So looking at it from a venture capital perspective, obviously you guys aren't just investors. You serve as valuable partners in a startup's journey. So can you elaborate more on your expectations for founders that you invest into? What are some qualities and some approaches that you value the most in a founder?
Yeah, so that's again, I think this is the expectations game that I was mentioning. So if we set up like a plan with those companies, and they propose us like that's what we want to do, and we tell them, listen, this is what we can contribute with, and if we are able to make that clear, I strongly believe that like as we mentioned, there is some product market fit, there is the founder problem fit, there is the company fund fit, right? So there is. So you need to look at it and have the right partners talking to the company and helping the company. And we want clear communications about the company status. It's amazing how we can be like very clear at the beginning of the relationship, and then things come kind of didn't go don't go as expected, and that happens. We've been there as former entrepreneurs. We know that we cannot deliver like every single quarter where we were expecting. Like there's always pitfalls and things that are not in our control. But the company kind of shuts off the communications, and we don't know what's going on. That's really bad. And we want to have that kind of transparent and candid relationship where expectations can be set, and then the contributions can be set, and everybody can help each other to achieve their goals. We want the company to be successful. Maybe the company needs some additional support. We are not aware. What can we do about it, right? So that's like being very clear and candid on all the communications and expectations. That's very, very important. And most of the times, unfortunately, that doesn't happen because there is this, like this. I don't know how that came to you, but this image that VCs they're dangerous. They may kick you out of your company, etc. And that's a very extreme case on, like most of the situations. That's not what's happening. I mean, 99.9999% of the cases are not that. But sometimes it happens, and then everybody kind of freaks out for something that never happens.
Right. No, it's a common misconception. When I speak to a lot of founders are actually very afraid to go the VC route simply because of what you just mentioned. In essence, it's just they have this fear as if they're going to remove them from their own company, and all that work that they put in would have been for nothing at the end of the day. So that's unfortunately the common misconception, but that's not really the case. And that's I've witnessed that. I'm affiliated with many VC firms. You working at a VC firm, that's not really the case. It's really, really rare,
especially nowadays where we have I don't know how many smaller funds that former entrepreneurs launch it, right? So they're not going to do. I mean, they understand like ourselves. We know what that means. So it's it's unfortunate that that happens.
I agree. I couldn't agree more with you on that. And I want to kind of shift our focus more talking about pitch decks for a little bit. You know, a lot of our founders actually in our community are kind of wondering certain aspects of a pitch deck. So the world of VC funding can feel like a whole high stakes game, you know, for startup founders. And one vital element is delivering a captivating pitch that grabs the attention of a venture capitalist and convinces them to invest into your vision and whatever it is that you're trying to build. Unfortunately, many founders stumble during this critical phase, and they're missing out on valuable opportunities. So, Rafael, with your experience on the other side of the table, you've seen countless pitches. What are some of the biggest mistakes founders make when they're pitching to VCs?
Now, I'd say that the biggest and the most annoying kind of error is pitching the wrong venture capital firm or the wrong fund, right? So, like ourselves, we are prop tech focused, early stage, and we get pitches from biotech to I don't know, blockchain, AI, whatever. So all the time. I mean, every day. I mean, tens or maybe hundreds of those pitches, which are not a fit for us. So first of all, I'd say that you need to do the research. I mean, the founder needs to do the research on who are the firms or the venture capital or the GPs that would be interested in their companies. You know, it's not just go over a database, download who are the investors in that area, and then email like spam them on that, right? So that doesn't work. So that's the first, I'd say, common error that we see all the time. But then, you know, talking about the deck themselves, we love like shorter decks, right? That are direct to the point that I mean, again, we screen about 1,000 companies a year. So we don't have that bandwidth to look at like long decks all day long. So if it's short, a good deck has, I don't know, 10, 11 pages, exploring the team background. So sometimes we get decks where the team is just like a LinkedIn link. And I said like, okay, that's not great because now I have to go to LinkedIn and figure out where the founder's background, etc. So if they can be clear what they did in the past, etc., and not overstate, because that's another error that we see all the time. People overstating their positions, their roles, etc. And then when we go and do our checks, that doesn't check. So it's kind of very, very disappointing. Buzzwords like or like this a few years ago was everything blockchain, now is everything AI. So I'd say that if you're not working on an AI model itself that's going to be available for other startups using it, and if you have like just an AI based something, you don't need to position yourself as an AI company because you are not. That's, you know, like cloud based system. You're not talking about like a cloud company. So it's the same as with AI. It's just part of the tech stack. So you need to be fair about and be careful with those buzzwords. On the entrepreneurial side, that we see all the time, like a serial entrepreneur pitching us. And I always ask myself, like, why a serial entrepreneur, like a successful one, needs to talk to me, right? Because if they are successful, they should have investors like willing to talk to them. You know, like all these buzzwords, kind of, they're gonna diminish the value of your business, of your what you're building. So don't do that. And it's very, very typical. Dex missing traction. We don't know where the company is, right, in terms of revenues. I mean, I believe that every single venture capital firm, they want to understand where the company is. So if you are just about to launch a product, you can say that we did, I don't know how many interviews, we developed an MVP, or we developed something where you are, or you have users, great, you have visitors, you have revenues. I mean, great. I mean, you should state your revenues. Let us know what we are talking about. Again, most professional venture capital firms, they will just, they know, like it's not an shame to be on a few $1,000s of revenues if you just launch it. I mean, we are interested. You don't need to kind of hide that in your deck. Make it clear where you are, which stage is the company, etc. And if sometimes we get decks with 3 to 5 pages explaining the problem, and then another 3 to 5 pages explaining the solution. And we say like, okay, this is not a good idea, because if you need like that many pages to just explain what you're doing, maybe this is not a good idea, right? So if you can be like super concise on in direct, like this is what we are tackling, this is the problem, this is the size of this market. That's great, and you don't need anything very fancy with lots of pictures and charts and things like that. It can be like blank with bullet points. It doesn't matter if you kind of give the right message on what you're working on, who is working on that, right? The traction, what you built so far, where are you in terms of the company, and what you're looking for. We, like all the times we get decks where there's no ask. I mean, this is a deck, but we don't know if they're raising Series A or pre-seed or so. It's amazing how you see that, and we have that all the time. So make your homework. Just build like a very straightforward 10, 11 page deck with all the details on what you're working on, who is the team, what's the traction, how the solution works, why you're gonna win, like competitors. We see a few companies, and even meet with companies where they are not aware of the competition at all. They didn't make any research there, and we say like, at least, but what about this company and this company and this company and this company that are working on the same area you are? It's like, oh, never heard of. So, oh, okay, so that's that's not great, right? So you need to map and why you're going to win. An ask, a clear ask. We are looking for. The other day I had a meeting with the guy in their deck. They wanted to meet with us. We want to meet with you guys because we wanna have ideas on what to do from here, because that's what we built, but we don't know our next steps. So, and that was great. I mean, it's okay, this is fair. I'll take that meeting. I've been there, and I'll take that meeting all day long. You need some help to figure out what's the next step. You don't know exactly what to ask. Just be clear.
Right. As long as you're able to properly deliver and articulate that message, that's really the key. I agree with you on that. So to summarize what you said, because we dived deep a lot into this, kind of keep things short, sweet, and simple. In reality, that's really what it all comes down to. Those three things.
And fair, right? So be candid.
Right, 100%. And to add on, I mean, I speak with tons of founders, and it's a shame that they're not able to conduct enough thorough market research into who their competitors are in reality.
No, sometimes we understand that they don't have all the resources to do that, right? So, but you need to kind of check around what's out there. I mean, with all the amazing search tools and AI search tools. It's quite easy to do that.
Yes, no, 100%. I think this was great, and I mean, as we conclude our episode today, I wanted to personally thank you for being a guest on our show and for sharing your valuable insights and expertise on really what a VC's role is in the startup ecosystem. So, if you enjoyed this episode today, be sure to subscribe to our podcast for more thought-provoking conversations with industry experts like Rafael. For our listeners interested in learning more about Rafael and Lab Ventures, we'll have their links to their website and social media in the show notes below. Thank you for tuning in, and until next time.